Yeah, also welcome everyone who's hopping in already. Um, Thanks for hopping in, Curtis and Taryn. If anyone wants to drop it in the chat where they are located in the country or where they have their short-term rentals, that would be awesome. Um, Bonnie and I are both in Western North Carolina. Excited to kind of dive into some lending topics. Bonnie, I know one of the things we were talking about a little bit, but previously was the new passing on of the Airbnb host percentages to clients, and you were talking a little bit about the underwriting of that. What's kind of going on there? Do you know like what the dates are for when that's going to happen?
Yeah.
Also, hey, hey,
Um,
hey, Taryn from Dallas.
hey there. Yeah, my understanding is that it goes into effect as of October 27th. So it's still a little ways out. Like it will apply to new reservations as of October 27th. It's
Hmm.
still a little while out, and I think everybody's kind of trying to absorb it and figure out how they're going to adjust their business practices and their pricing. A lot of people use dynamic pricing tools, and so I think that that's probably going to um, be really critical to figure out what your market is doing and how you want to price accordingly relative to this new fee structure they have. But I think on the lending side is what you're really asking. And, most of your short term rental lenders are familiar with and rely on AirDNA. So unless we see AirDNA adjust their algorithm relative to this new fee pricing, then I don't think we're going to see it right away show up on
Yeah.
the AirDNA projections. But it'll be really interesting to see
Mhm.
how that plays out because I'm not hearing anybody talk about that part of it yet.
Yeah. Yeah, and for everyone who's joining, welcome to today's Savvy session. Bonnie and I were just chatting a little bit before we dive into her presentation about some of the new Airbnb restructuring of the fees over to the host side. And so we were talking about that as it relates to lending and the underwriting process there. And if you just hopped on, go ahead and drop in the chat where you are located, where you are investing in. Would love to see where everyone's at around the country. And then we'll get started with Bonnie's presentation here in a couple of minutes. But yeah, go ahead and drop in the chat where you're at, where you own STRs. If you are looking for an STR by the end of the year, that is also something we're super curious to know. And my team can reach out to you and we're just going to be talking a little bit today about DSCR loans, and Bonnie was just mentioning, AirDNA and what it's going to look like if they're going to be restructuring how they report their information for underwriting. So, any other thoughts on that, Bonnie, before we rock and roll?
Yeah, no, I just think it's going to be interesting to see how it plays out. I know I'm certainly nervous as a short-term rental host myself. My property happens to be located in Lake Lure, North Carolina. I think most people realize that this area was hit very hard by Hurricane Helene last year, and we're still really recovering. Tourism is still recovering. So it does concern me, and I'm certainly doing my homework right now to try to understand what the market around me is doing relative to this new pricing feature of Airbnbs, where they're essentially shifting all of the fees that the guests used to pay directly onto the host. So the host will be paying both sides of the platform fees. It's
Yeah,
pretty significant, bumping it up to 15.5%. And
yeah,
so
and we'll see if
we can
AirDNA
really,
captures that in the
yeah,
underwriting.
we gotta figure out how we make up for that. And it's going to be interesting to see how
Yeah,
people are
definitely.
doing
And
it
that's kind of, I know
differently.
for us, where our high season is October. So it kind of stinks that that trying to jockey for position and
Uh-huh.
capitalize on high season is going to be the time that we've got to figure out the new pricing thing. But we're keeping our eye on it, our ear to the ground, and obviously we'll let everyone know what's going on. But yeah, let's go ahead and get started here. We're a little bit 3 minutes past the top of the hour. Anyone who is here that hopped on, go ahead and go ahead and throw in the chat where you're located, where your STRs are. If you're looking for something by the end of the year, we're really in that season where we need to take advantage of the cost segregation benefits. And you've got, a month, maybe a month and a half if we're being generous to start getting something under contract. And so, yeah, so anyway, I've got Bonnie Lowe here. Bonnie is one of the lenders that we love working with. She is with MGM Capital Investments, and Bonnie not only is a lender that we love partnering with, but Bonnie is also one of our clients at Savvy. She bought with us here in Western North Carolina a little bit ago, and just had a fantastic relationship working with her then. And so we've been excited to invite her back into the fold and start, having her deliver that same level of service we do at Savvy to, our clients, but on the lending side. And so we're really excited to introduce her. Again, I see we got some more people who just hopped on. Go ahead and throw in the chat where you're located, where your short-term rentals are, and if you're looking by the end of the year. But otherwise, I'm gonna go ahead and turn it over to Bonnie. We're gonna chat. If you have any questions throughout the presentation, go ahead and throw those in the Q&A or the comment section, and we can, address those as they come up and definitely take questions at the end. So thank you so much for being here, Bonnie. It's great to have you.
Thank you. I'm excited to be here, Scott. I'm very excited to be working with Savvy Realty. You guys are near and dear to my heart. As I put in the chat, I own a short-term rental myself in Lake Lure, North Carolina. And Tyler Kuhn was my real estate agent in 2023. He represented me on that transaction. So uh, real good affinity with the company. I did lose my audio there for just a little bit, and so I didn't hear your intro, but I assume it's okay for me to go ahead and just jump into the presentation.
Yeah, of course. Yeah, my intro was just talking about how amazing you are and how
Okay.
much we enjoy working with you, and how you're very much on that same level of diligence as us over at Savvy, and speed and diligence are everything in this industry. And so, yeah, go ahead, take it over, Bonnie.
All right. Well, thank you. Oh, that's a big picture of me. Hello. So I'm a lender and an investor. Been investing since 2016, and wanted to get into the lending side of real estate because I felt like there was a better way to do things, and it didn't feel like a very open and transparent process to me. I felt like I was constantly uh, just providing every document I could think of and crossing my fingers and hoping that things worked out. And sometimes they did, and sometimes they didn't. So I wanted to be a different kind of lender. I wanted to be very involved with my clients. I wanted people to really understand what they're doing and how to underwrite their properties. And I partnered with Matt Miller at MGM Capital, and we're here today working with Savvy. So this is a picture of my beloved cabin in Western North Carolina, just to give you an idea. I walk the walk, talk the talk. I also have a portfolio of long-term and mid-term rentals. Those are all in California, which is where I'm from originally, although I currently reside here in beautiful Western North Carolina. All right, so a little bit about MGM Capital, built by investors for investors. I think that's really important. It's one of the things that makes us stand out. We do understand this. We eat, sleep, and breathe real estate, and we both enjoy it very much, maybe too much. Matt Miller, I think Matt is on this call. Hopefully, he's able to jump on today. He's our founder and CEO. Been in the mortgage business for quite some time, works on both the conventional and the non-QM or investor side. Matt is a boy dad and a Atlanta Braves fan. Uh, I don't work on the conventional side. I work on investor only. So when you see DSDR, fix and flip, those types of loans, that's my specialty. That's where I come from, and that's what I focus on. I too am a boy mom. I have three grown sons and three grandsons that I'm very, very proud of. And I'm a lifelong Green Bay Packers fan. Um, and so we are brokers. What that means is we work with a very deep bench of lenders. And the reason we do that is because every borrower and every scenario is different. When you work with a direct lender, that can be a good thing if they have the product you need and if they have the rate and terms that you need, but they're limited to only what they offer. As brokers, having such a large network of funders that we work with, we're able to find a solution and meet you wherever you're at in your borrowing journey. You could have challenges like maybe your cash to close or your down payment is very sensitive. Maybe you need a very fast close. Maybe you have a loan that was with a different lender, but it is going sideways. We can step in and take over that loan. We have foreign national clients that we work with, some of whom have US credit, some who do not. We have funders for those types of situations. You might have a complicated entity structure. All of these require a different loan product or a different loan approach, and that's why we have such a deep bench of lenders that we work with. All right, so let's get into a little bit about the products and how we work with our clients. So generally speaking, this crowd of STR investors, I'm going to speak to the investor loan side of it. Now, some of you may be looking to purchase a home, a vacation home using the second home loan product. I'm not going to talk about this today. I don't represent those. Savvy has another preferred lender for those who does an excellent job. In fact, I use that product myself. I highly recommend it. But if you are not pursuing a second home loan and you're looking for something like a DSCR, fix and flip, ground up construction, a bridge, or even a commercial loan or a line of credit, we're your go-to lender for that. These are all very common investor loan products, and we'll talk a little bit about how they work and how you can leverage them for your business. So first and foremost, that is what we're here to offer and work with you on. Secondly, I think it's really important to understand that we're investor loan strategists, and I would highlight the word, or I would emphasize the word strategist. Borrowing should be a strategy. Your lender should want to sit down with you and have a conversation and really understand where you're going. We want to understand what your goals are, not just for this acquisition, but where are you headed in the future? Are you scaling? Are you scaling rapidly? Are you expanding to new markets? Are you breaking into a new asset type? We all want to understand all of those things so that we can help craft a borrowing strategy that is not only going to suit you for this loan today, but is going to set you up for success in the future. And you really have to kind of take a long-term thinking approach and really get to know your client in order to find the right product that's going to meet those needs and to best serve our clients. And so that's where the strategy piece of it comes in. We're also able to get very creative because we understand our product so well, and because we have done this before and we know how to combine products. We know how to use some creative strategies to get you into a loan that otherwise you might not have thought of yourself. That's where the strategy part really comes in. And I really emphasize that that's something that as investors, particularly if you're wanting to do more than just a single acquisition, if you're going to be growing and scaling, you want a partner on your team who is a strategist and can really help you maximize your funds that you have available to do just that. So why work with us? Well, aside from what we've already discussed, we highly, highly, highly value transparency and communication. And I think that comes down to, or what I've been told by my clients is, it comes down to sort of a concierge level service. We are with you every step of the way. You've probably had an experience before where you've had a good conversation initially with a loan officer, but then they hand you off to their team and you don't talk to them maybe ever again throughout the life of your loan. That can leave you feeling very frustrated. It can leave you feeling in the dark. You don't have a lot of confidence that things are moving forward. You don't hear from them unless they're asking you for documents that you've already submitted once or twice already, and you wonder, what the heck is the matter with your process? What did you do with my documents? We don't do that. We've got systems and tools in place to make sure that we are very efficient. We are communicating with you every step of the way, and we're communicating with your realtor, which is a very important piece of it. We are working together with your realtor to make sure that your transaction is going to go through smoothly. And if anything does come up, we're on it right away, and we make sure that it is resolved so we can continue moving forward and meet your deadlines, right? Your closing deadlines. We also have funders that we work with again and again and again, and we do that because they're the best in the business. They offer the best rates and terms. They have the best process. They have, modern infrastructure like portals where we can handle your data securely and efficiently and in an organized fashion. And all of that is very important. You would be shocked at how many lenders are still doing things, via email and the old fashioned way. And it makes for a very wonky process if you're the borrower. We shy away from those types of lenders, and we only work with ones that have systems that are compatible with our expectations for professional investors. We also have influence with our funders because of the deal volume that we send to them. We're able to get our projects fast tracked and prioritized, and we're able to get them on the phone and talk through any situations that come up. And that alone is just worth its weight in gold. So this is what you get when you work with MGM Capital. This is our commitment to you as our clients. All right, so I'll talk just briefly about these products. We can always circle back to them because there's a tendency to do a deep dive on these and then we don't get to some of the other more important parts of the conversation, or I should say equally important parts of the conversation. So let's talk first about DSCR. This is a term you may have heard. It stands for debt service coverage ratio. These are very common, very popular investor loans, particularly with short-term rental buyers. Very simply, it means, will your property pay for itself? That's one way to think of it. This is kind of an overview of what we're seeing in the market. Our rates, or our leverage rather, is up to 85% LTV is loan to value. Rates are currently like in the mid sixes to mid sevens for well-qualified investors. Certainly can sometimes come in as low as 6%. So as you can see, they're not that far off of conventional. Right now, this is typically a 30-year fixed product, and we have funding for DSCR acquisition on the low end, 75 to 100,000 up to 10 million. So a very, very broad spectrum of potential borrowers that we can cover with the DSCR loan. The way I like to describe DSCR, in case you're wondering what the whole debt service coverage ratio is about, is very simply this. We want to look and see if your net operating expenses equal your revenue. If they do, that's a 1.0 DSCR ratio, and that's typically the threshold for where we begin. The caveat is that sometimes you can go below 1.0 debt service coverage ratio, but we won't spend too much time talking about that. So the way to think about it is, if your principal, interest, taxes, insurance, and association fees, so that's PITIA. If your PITIA is equal to your revenue, your monthly revenue, then you have a 1.0 debt service coverage ratio, and that tells us that the property will pay for itself. And that's the primary factor for underwriting. Now, the better your debt service coverage ratio, the better terms you're going to get on your loan. So for example, if your PITIA is $1,000 a month, your income is $1,200 a month, you have a 1.2 debt service coverage ratio. And so as that goes up, you see that you get better leverage and you get better interest rates. The other factor that we care about here is your lendability as a borrower. So we're going to look at your FICO score. And if you have partners, like you have an entity with multiple partners, we're going to take the best FICO score amongst you. That matters because while many investors purchase their property using an LLC or some type of an entity structure, and that's fine, you don't have to, but you certainly can. At the end of the day, there still has to be a personal guarantor on these loans, and you are the personal guarantor. So we don't care what your W-2 income is. We're not going to ask for pay stubs. We're not going to ask for your tax returns. We don't care about your debt to income. We care about your lendability as a borrower, and that's your FICO score, and we care about the performance of the property. Those are the primary things that we're looking at on the DSCR. On the fix and flip product, I know that this is less commonly used in the STR space, but I think there's a conversation to be had for why this is a valuable product and why it could be beneficial to a lot of borrowers. And I don't know if it's just coincidence, but over the last few days, I've had several conversations with short-term rental borrowers who are interested in this product. So with a fix and flip type loan, this is a hard money loan, so it comes with higher interest rates, which are typical for this type of borrowing. It's a short-term loan, usually between 6 to 12 months. It allows you to get into it with a very, very low down payment. Typically, we can fund 90% of the acquisition and 100% of the rehab. There are circumstances where we can go higher than that, but that's a good rule of thumb. If you have a property that you're buying, and let's say it's not a short-term rental right now, or maybe it is, but it's dated, and you want to do some really interesting upgrades to the property, you might consider using a fix and flip loan. It allows you to get into it for a lower acquisition price, fund your rehab, stabilize the property, and then refinance at the end of your term into a 30-year fixed, like a debt service coverage ratio DSCR loan. So there's an interesting way we can combine those products to make that happen in this space. Ground up construction is another. I know a lot of people are interested in building their short-term rental as opposed to buying one that's turnkey and ready to go. We have ground up construction loans. We actually have really, really good terms and a number of products to choose from there. Bridge is kind of a what it sounds like. It's a bridge to another product. Sometimes you need a little extra funding or a little extra time. We can do that. We have several vendors that have some great bridge loan products. And then we've got commercial products as well, and others too. I'm not going to go too far into the weeds, but basically, if you've got some mixed use, I just had one of your savvy agents reach out to me the other day, Scott. She has a client who has sort of a short-term rental compound, I guess you'd call it, where it's a mix of cabins, tree houses, and some other interesting properties. Those can be very, very difficult to finance. They just don't, fit the buy box for most lenders, but we have commercial lenders that will do that. In fact, I'm talking to a commercial lender about that one just right now. So as you can see, we kind of have a product for everybody. And I'm happy to take questions, go into more specifics about those. If you are a borrower and you're thinking about making an offer on a property and you're not sure what loan product to use, this is where I would encourage that you reach out to me and start that conversation. Tell me what you're looking to do, and I can help you decide what product is going to work best in your situation. And I can give you some different options. I can quote you or give you an estimate so that you can run the numbers and do your due diligence on your underwriting. That's part of my role, is to help you facilitate that so you make the right decision going into it. How are we doing on time, Scott? Can
Yeah,
you
we're
hear
doing
you?
all right.
Okay, cool. I'm not monitoring the chat at all, so I
Yeah, it looks like
am
Taryn had a question about ground up numbers. Um, Taryn, I think we'll circle back here a little bit and do a Q&A and can cover that since it's a very specific question about a loan type. Does that work?
yeah.
Cool.
All right. Okay, so let's talk a little bit about what it means to think like an investor. I know for myself, like I was so obsessed with underwriting the numbers for a short-term rental, and I do this with all my properties. Like a lot of us have learned, we've come up through Bigger Pockets or some other type of coaching program, and they say, you need to get so comfortable with the underwriting process. Underwrite 10 deals a day, even if it's not 10 deals that you're interested in working on. So I would use the online calculator like Deal Check or the Bigger Pockets calculator, and I would run my numbers. I'd run my numbers for flips. I would run my number for burrs. I would run my numbers for a long-term rental and really try to understand how those numbers relate to one another so that I could do my due diligence when I was doing my underwriting. And if you don't already do that, I highly recommend that you get familiar with it. Now, I feel like Savvy does an excellent job of providing a lot of that data to their customers. And in fact, I remember one of my first conversations with Tyler Kuhn when I was looking at short-term rentals. We were discussing this property, and I said, well, I've done my underwriting on it, and here's what I think the numbers look like. And Tyler said to me, wait, why are you doing that? I like to do the numbers. That's fun for me. And so we kind of had a joke about it because we realized, like, we must be the same kind of nerd that we love running these numbers, but there is something really fun about it, I think, which is probably why I got into the lending business. But the point is, you should have a comfort level with underwriting properties, and you should not rely on somebody else for your due diligence. Lean heavily on the resources that you have, like your savvy realtor. like your lender, myself, hopefully. But at the end of the day, you should really understand what those numbers mean, and you should be very, very comfortable with the process. And so that is something I am happy to walk you through and help you with so that you feel like you have a good grasp and can evaluate number properties really quickly. Because sometimes what you're trying to do is you're not trying to qualify. We used to call it killing a deal early when I was in sales, right? Like the first thing we're trying to do is we're evaluating a deal to see if we can kill it. Because if we can kill it, we can move on, and that helps us focus on just the ones that we really want to pursue. So that's one way to think about the underwriting process, but you really want to have a good grasp of it. So use the tools that are available to you and really get comfortable and familiar with it. We just talked a little bit about how DSCR loans work. And I'm going to show a tool. I'm going to show you a tool in a little bit here that I use that is a go-to for you. But you know what's a great tool and people are just sort of warming up to it now is ChatGPT. If you ever wanted to know what your debt service coverage ratio is, you can create a formula in ChatGPT or ask it to create a formula for you. And you just feed it the inputs and it will spit it out for you. So there's no reason for us to hoard these resources. We really want to share them so that our investors are well educated and able to do this for themselves. And I highly recommend that you give it a try if you're not already using ChatGPT to help you with your deal underwriting. Trust but verify, obviously, is always the caveat there. Double check your numbers. All right, so when we're going into a DSCR loan, in order to do our underwriting for the property, we need to know what our offer price is going to be, what our interest rate is going to be, and we also need to know what it's going to rent for. So you want to know when you go into it what your end use is for it. In most cases, I'm going to guess people in this audience are going to be using it as a short-term rental. The good news there is whether it's an existing short-term rental or not, we can use AirDNA data in order to determine what it should rent for as a short-term rental. With a DSCR loan, we make sure we are working with lenders who will accept AirDNA data. Not all of them do. So we want to make sure that we are using the lenders who are most familiar with underwriting for short-term rentals and are really comfortable and confident with AirDNA data. You might want to underwrite it as a long-term rental, and I will tell you my personal tip is I would underwrite it as both. And the reason for that is even if you never have any intention of renting it out as a long-term rental, you never know when things are going to change and you might need to. Case in point, Hurricane Helene. I underwrote my short-term rental using STR numbers and using AirDNA data, but I've had to pivot and do several different things to keep that property afloat. Now, this is an extraordinary circumstance, but it's just an example of wanting to know that your property is going to be affordable for you no matter what happens with it in the long run. If it underwrites well as a long-term rental or even as a mid-term rental, but your strategy is short-term rental, you are going to have a comfortable cushion there, and you should be very confident with that approach. Midterm rentals, I've been getting a lot of these questions lately. One of my niches that I play in is the midterm rental space. I love midterm rentals. I actually host a nationwide group for midterm rental hosts called VMTR Connect. We're kind of the OG in this spot in terms of virtual host meetups. If anybody's interested in joining, please just message me and I'd be happy to add you to our roster. It's a free group. But I'm getting a lot of questions from people like, I want to buy a property. Will my lender underwrite it as a midterm rental? Right now, that's not really happening. It kind of takes a while for lenders and underwriters to catch up with what's happening in the market. I mean, it wasn't that long ago that lenders really didn't understand how to use AirDNA data, and now it's pretty common. So midterm rentals, which kind of fall in between long-term and short-term, can be complicated to underwrite, and for the most part, your lender is going to underwrite it as a long-term rental if your strategy is to use it as a midterm rental. They just don't know how to do it otherwise. But that's okay, because if it cash flows and it meets your requirements as a long-term rental, you can be rest assured you're probably going to do considerably better than that as a midterm rental. We usually tell people to use 1.5 to 2.5x your long-term rents in the midterm space. So that's just a little FYI if that is something that you are interested in, and we can always chat about that if that's part of or your exit strategy for your property.
Hey,
Number
Bonnie.
three, yeah,
Joseph had a question about air DNA data. He was saying that one problem he's seeing right now is that the trailing 12 on AirDNA is basically 2 summers. So revenue seems about 30% higher in most of the markets he's in. Do you have any comments about that?
yeah. I mean, I think that it can be difficult, and it's just an unfortunate place with the data or the tool itself. However, we don't have to use AirDNA data. So if it is already an existing STR, and in your case, like you were mentioning, 2 years of trailing data, if you have actual rents for that 2 year period, we can underwrite it using that. So we can do either. So that's one way to maybe better reflect reality. Now that might help you, that might hurt you, because if you're trying to buy a short-term rental and it hasn't been operated particularly well, and you know you're going to do better, that number might hurt you. But if you think that it's a more accurate reflection than what you're seeing in AirDNA, then I would want to have a conversation with you about why you think that and where your reference points are coming from. And if that is a good argument, then I will go to bat with the lender to try to uh, get them to underwrite based on those numbers instead. But it's situational. It's case by case. Does that answer it, Scott?
Yeah, I think so. Joseph, drop in the chat if you have any further questions on that one. But yeah, go ahead. Go ahead, Bonnie.
Yeah. All right. So, everybody's concerned about efficiency, and I know one of the things that drives people nuts about their prior lending process is not feeling like they understand where their loan is at, or that they keep getting asked for the same documents over and over again. And that really comes down to efficiency. So on the one hand, like I said, we tend to work with lenders who have a great process for that. And we ourselves have built-in processes so that we can really keep track of exactly where your loan is at in its life cycle and everything that you've submitted and everything that's outstanding. That's us doing our due diligence, but you can do it as well as a borrower. You really want to get your ducks in a row relative to your documentation. And so what I recommend, particularly if you're a very active investor and you're going to be buying more than once a year, is create a file structure in your computer system where you have all of this documentation and you keep it updated. So we're going to ask for, a schedule of real estate owned, which means what properties do you currently own? We want to see current mortgage statements on those because we want to make sure that you are, paying your obligations on time. So every month when your mortgage statement comes, just grab a copy of it and stick it in that file folder. It's going to be very easy for you to just do a drag and drop and send it to me later. We always want to see 2 months of bank statements. So when your business bank account statement comes every month, drop it in your folder and be ready to just drag and drop and send it over to me when you have it. When you do a closing, we're probably going to ask to see your HUD statement or your closing settlement from that refi or that acquisition. Same thing, you should have a folder for every one of your properties, and you should keep your HUD statements or your closing and your settlement statements on your computer so that they're really easy to access. People get frustrated when you feel like you have to scramble and I don't know where that document is and I don't know if this is going to be acceptable. Same thing with your entity documents. So if you have an LLC, know where your operating agreement is, your articles of incorporation, your EIN or employer identification number, your certificate of good standing. Keep all of those things fresh and ready to go, and it's going to make the process so much simpler. One of the things that we provide for our borrowers is whether you're doing a fix and flip or DSCR or any other type of loan, is we're going to give you a document when we start out and say, these are the things I'm going to need from you so that you have it in black and white and you can prepare. Even if you're still in the phase where you're making offers and maybe you don't have something under contract yet, you can be getting your ducks in a row by making sure that you have all of those things and have them lined up. It's not a lot of things. And frankly, as an investor, as a professional investor, these are all things that you should have and be familiar with anyway. It just helps you to be organized and have them ready when the time comes when we're going to need it. Number four, your financials really comes down to your FICO and your cash to close and liquid reserves. So you should know it sometimes is painful. I know I went through a phase, when I was like in my 30s and we were young and struggling and it was tough. I never wanted to open a credit report. I didn't want to see where I was at. I was afraid to see where I was at. And I obsessed over every little bump up or bump down. But when you are a professional investor, you do need to be familiar with that number. You should be familiar with it. You should have some type of credit monitoring service because when you ask me to quote a loan, I'm going to ask you, what do you think your FICO is? And you should be in the ballpark. So have some type of credit monitoring service, know what your FICO is. We will run your credit. I will say that this is an example where it helps to have lenders that have a very broad bench. Some people do not want us to do a hard pull on their credit. They're very sensitive to fluctuations in their credit score, and they want us to be able to work with a lender who will do a soft pull on their credit. If that is your situation, just be upfront and tell us right from the get-go so that we know that and so that we tread very lightly in that area. You're always going to need liquid reserves. Not only is your lender going to require liquid reserves, 6 months operating expenses is pretty typical. So your PITIA times 6 is pretty typical for the market that we're in today. It used to be like 3 or 4 months, but lenders have gotten a little nervous just with this, where the economy is at. And so we see them asking for roughly 6 months in reserves pretty commonly. You should have that. Now, that does not mean you have to bring it to the table. A reserve is just what it sounds like. You have it in reserve should you need it, but you have to demonstrate that you have it. And so that's where we're going to be looking at the bank statements to make sure that you have it. And it could come in the form of, savings. It could be in your 401k or retirement account. It could be stocks. It could even be in crypto. But the key is it has to be liquid. And so we're going to find out what your requirements are. So for example, I know with my 401k, when I was still working for my prior employer, I could only borrow up to 50,000, and sometimes it takes more than that to get into a property. So we'll work with you to find out what the situation is with your particular reserves and make sure that you're able to demonstrate to the lender that you have them, and it can come from a variety of sources. The nice thing that is, unlike conventional lending, on the investor side, we typically don't care about seasoning. So you can, seasoning just means like how long has it been in your bank account. A lot of lenders will source it. They want to know where it's coming from. So let's just say you transferred money from stocks into your savings account so that you can show that it is now liquid and available. That's fine. They don't care if you did that yesterday, just so long as the funds are in the account when we are going through the underwriting and the closing process. So just be prepared on that front as well. When I'm working with a borrower, I'm going to tell them early and upfront estimate of their cash to close. We don't usually know exactly what the number is, but we can get you pretty close because we can't anticipate what third-party costs are going to be, like attorney fees, title, recording, document handling charges, all of those types of things that you see on your closing statement. We can get you pretty close, but it probably won't be exactly dialed in, but we're going to let you know that as soon as possible so that you can begin preparing. And because we never want there to be any last minute surprises. That's not good for you or us or anybody else. And then finally, your entity document. So we kind of talked about those already. You don't have to buy your property in an LLC. Some people do, some people don't. If you are using an LLC, you are still the personal guarantor of the loan. So know that, and that's why your FICO is always going to matter. But if you are buying in an entity, you should have your operating agreement, your articles of incorporation, your EIN, which is your tax number, employer identification number, and you're going to need a certificate of good standing. You should have the first three easily on hand. The certificate of good standing, you're probably going to go to the Secretary of State's office and download a current one because it typically needs to be produced within 30 days of when we apply for the loan so that we know that it is a current certificate of good standing. Very easy to go online, usually costs you like $10 to $25, depending on what state you're in. But those are the types of documents that you need to have ready. Sometimes there's a couple of others, but they're less common, so I won't go into those, but just know that we're very familiar with what they are, and we will tell you exactly what you need and give you time to get those documents together.
Hey, Bonnie. Randy had a question about liquid funds and was curious if availability on a HELOC counts or do they need to be in a checking or saving account?
So availability on a HELOC does count. You can absolutely use your HELOC. In most cases, you can do an actual draw from your HELOC. So as long as you can do a draw, like literally, have checkbook control over your HELOC, then you're fine. If for some reason you have the type of line of credit, HELOC is a term that gets used sort of ubiquitously, but there can be a difference between HELOC and a line of credit. So just depending on what your terms are, know your terms. And if you don't have checkbook control, or debit card control, then yeah, we would want to do a transfer of those funds to your savings or your checking account for your business or whatever you're using to purchase your property with. So yeah, we can kind of do either is the net with HELOC funds. I will say with crypto, that's the one where I keep seeing, it's becoming more and more common. And most of your lenders do want the crypto to be liquid. So they would make you, let's just say you had 25,000 in your crypto funds that you wanted to use. Um, they are going to want you to liquidate that and put that in an actual savings account. And I believe the reason for that is that, we've all seen the volatility in crypto. So that 25,000 might be $15,000 tomorrow. So when it comes to stocks and crypto, they are typically going to want to see you liquidate those. And you can always move that money back when you don't need to use it any longer, right? So it doesn't have to be, always and forever, but at least for the purpose of securing your loan and knowing that you have the reserves that you need to operate, they should actually be liquid funds. Okay. So let's just talk a little bit about working with your lender. Your lender is such a key part of your team. It should never be an afterthought. I mean, I really highly recommend you to develop a relationship with your lender before you ever make an offer for a couple of different reasons. One, you want insight into the type of information that we have just talked about here today, and your lender can help advise what loan product is going to work best for you in your particular circumstance. When I'm working with a client, I'm developing a relationship. We at MGM, we are not transactional lenders. So in other words, we don't just care about this loan today. We care about those loans that you're going to do in the future and making sure that whether they're with us or not, we are still setting you up for success, right? So I can't emphasize how important it is to think of your lender as a key team member. The other thing that we're going to be able to do for you is we can get a second set of eyes on your property. I have clients that do this all day long. This is what I do. They'll send me a deal. I'm looking at purchasing 123 Ocean Boulevard. I think it's going to rent for X. This is going to be my purchase price. Can you tell me what the DSCR is going to be on this? Can you tell me approximately what my interest rate is going to be on this so I know whether or not this deal is going to work for me? And I'm able to do that. But if I don't have a relationship with you, we're coming in after the fact, giving you those numbers, and you might not like what they look like. So let us help you early and often. Um, the other thing that we do is once you are working with us, we have a portal where we will create a borrower profile for you where we're capturing your basic borrower information. It's not a full-on loan application, it's simply your borrower information. But being in our portal will allow me to create a pre-approval letter for you. And I strongly recommend, and your realtor would probably say the same thing, when you are ready to make an offer, going in with a pre-approval letter that says, Joseph is pre-approved for 123 Main Street for $750,000 by MGM Capital. That's going to carry weight with your offer as opposed to everybody else's offer. So let us work with you in that way to prepare you to set you up for success so that you can hopefully get that property under contract. Now, a lot of times we get into situations where there's negotiation, there's back and forth. You offer 750, seller comes back and says, we want 775. You counter at 765. I can easily update, if you're on our portal, I can easily update that offer pre-approval and send you a new letter that you can submit with your new offer. So that's one of the many ways we work with our borrowers and work hand in hand with the realtor throughout the transaction. And that's why you want us on your team early so that we can support you in all of those ways. Tell your lender everything, really. I mean, There is zero judgment here. Uh, Guys, I used to be so broke, it's not even funny. I've been there. I've had terrible credit. I've struggled. I've been a young parent with young kids and trying to operate a business. I know how difficult it is. Um, and and because of that, I think I come from a place of empathy. I also, being a mom and a grandma, I want to help people. I want to support people. So if you share with me your circumstance, what is happening right now? Maybe you're going through a divorce that can, change your financials. It can change your borrowing situation. Um, maybe you are short on funds. Then let me help you figure out a creative strategy so that we can get you into a property. Maybe you have equity in another property, but you don't have any liquid funds right now. Let's talk about what's in your portfolio and if there's a way to cross collateralize or to pull equity out of some of those other properties to get you into the purchase you want right now. A lot of active investors are asset rich but cash poor because they've got a lot of their money into their existing projects. Let me know so that we can work with all of those scenarios. All of those things are solvable. Everything is figure outable. It's rare that we have a situation that we just can't help with. But tell us what's going on so that we don't have any surprises. I've had loans almost go south at the last minute. I was doing a fix and flip loan recently for a property up in South Bend, Indiana. And typically, when you're doing a rehab, and in this case, it was a pretty extensive rehab, there's not going to be a tenant in place. It's not a great idea to try to do a rehab and work around a tenant. But I was working with a relatively new borrower. I don't think they had really thought through all of that. And it turned out that they had a 6-month fix and flip loan, but their tenant's lease didn't expire for 4 months, which means by the time they got the tenant out, they'd have 2 months to complete their project. We literally found out about this the night before we were supposed to close, and it was only because I was copied on a thread between him and his realtor, where he was asking the realtor about transferring the tenant's security deposit to him from the seller and making sure that that was caught in the escrow process. Fortunately, I saw that. We discussed it. I did have to highlight it to the lender, and several things changed, right? Because his insurance policy that was going to be in place for the fix and flip loan said that the property was vacant. If he had gone forward and put that insurance policy in place, and then God forbid anything happened to the tenant during the time that they were actually doing the rehab around him, that insurance policy was not going to cover it. And so a lot of things had to change at the last minute. It would have been nice had we found all of this up front so that we could have worked around it. We didn't. We found out about it at the last minute. Thankfully, we had a amazing lender to work with, and we worked through all of those things. And we were also able to suggest that he move forward with a cash for keys strategy to offer the tenant the ability to relocate earlier before their lease expired. He did exactly that, successfully relocated the tenant, and now his property is vacant, and he's able to get the project done quickly without, basically incurring 4 months of holding costs, in which time he was not able to do any of the project work. So those are the types of things that, can be built-in surprises that we'd like to try to avoid. And the more we know you and the more we know about your project, the more we can anticipate and work around those types of things. It's going to be key when we're looking at your financials. We're always going to ask if you had any late mortgage payments in the last 12 to 24 months. Hopefully the answer is no. If there are, let's talk about it, because there's usually workarounds for that as well. But I just don't want to find that out at the last minute, because it could jeopardize your loan, and we never want that to happen. If you're working with a co-borrower, let's talk about your co-borrower. Maybe your entity documents reflect a co-borrower, but your application did not. We want to make sure those things are matched up. And then lastly, I want to talk just real briefly about properties that are in an HOA or a condo. And this is part of your due diligence process as a borrower. If your property is in an HOA, we want to know what those fees are going to be, because that affects your PITIA, right? So the A in PITIA is association fees, and it can be dramatic. Sometimes they're, $20 a month. Sometimes they're $599 a month, and that is really going to change your debt service coverage ratio and your cash on, or your cash flow if you're investing for cash flow. The other thing that can be tricky are rules relative to lending on a condo. I've had a listing where somebody made an offer, it was listed as a townhouse, came to find out about 2 weeks into the loan, it was actually technically a condo and it was a non-warrantable condo. That completely changes the loan terms. So we want to know about that up front. We don't want any surprises there. And you want to know whether or not your condo association or your HOA is going to allow short-term rentals. A lot of them don't. And even some that do are actually not very friendly towards it. So that's a conversation that you want to have with your realtor to make sure that you're getting into a solid property where you will be able to execute on the strategy that you have in mind. So that's just a word of warning. Ask for the CCNRs, ask for the operating rules for your HOA or your condo association and read them and know what applies to short-term or mid-term rentals if that's what you're doing. So yeah, these are just all lessons learned and things that I wanted to share with you all to help you be a little more prepared. This is kind of we're getting towards the end of the presentation here. I did just want to mention for our savvy clients, MGM has an incentive, which is we will credit you up to $750 on your appraisal, and that comes out at closing. And so in most markets and with most types of properties, that's going to cover all most, if not all, of your appraisal costs. So you're going to put it up front, but we're going to credit it back to you at closing. So that's kind of a nice incentive right now for our savvy clients only.
Taryn had a question, just wanted to, oh, Matt answered it in the chat, but just wanted PITIA explained again.
Okay, so PITIA, I'll go a little bit slower this time, and maybe Scott, you type it in the chat or something. PITIA stands for principal, interest, taxes, insurance, and association fees. Those are your net operating expenses when it comes to a debt service coverage ratio loan.
Perfect. Thanks, Bonnie.
Uh-huh.
Any other questions for Bonnie? I know she has a tool that she wants to show us, but if you have any
Yeah.
questions, go ahead and drop those in the chat and we can get to them. And also, if you want to get in touch with Bonnie, we'll go ahead and drop her email in the chat. If you want to get in touch with me or my team, you can reach me at scott@savvy.realty, and then Bonnie is Bonnie at mgmcapinvest.com. So we're excited to help you. I know it's getting close to the end of the year and we're moving through cost seg season. So just wanted to say that in case anyone was going to hop off. But yeah, any questions, go ahead and drop them in the chat. And then I think Bonnie also had a tool to show us that she might get started on and while the questions come in.
Yep. So are you seeing the screen with my contact info here?
Yep, that is all up.
All right. So great. You can scan that QR code and that'll take you directly to a calendar link and you can schedule a call with me if you'd like. So yeah, let me escape out of here and show a tool for y'all. Okay, so if you're wondering how to figure your monthly payment, I like this tool. It's very simple. It's very intuitive. It's called Carl's Mortgage Calculator. Anybody can download this or just it's an app. Just go to the app. And you're going to put in your loan data here. And I want to show you something just for the purpose of illustration. So here's the property value is 550,000. You're going to put 20% down. That's 110,000. That's not closing costs. That's just the down payment. So that gives you a loan principal of $440,000. So what is a $440,000 loan going to cost you if you have a 7% interest rate? Well, it's amortized over 30 years. Your payment's going to be 29, 27, 33 per month. So that's a great starting point. I know all of us tend to obsess over interest rates, like it's always in the news. And I think we're still kind of having sticker shock. If you were investing 3 years ago and you were getting a 4% investor loan and now you're getting a 6.5% interest loan, it just still sounds outrageous unless you're as old as I am. When I bought my first house in the early 1990s and I was paying like 7.5 interest rate on that loan, right? And so we've talked about a lot of things about what make a good lender and how important it is to have a very solid relationship with your lender. And so I can't stress enough that interest rate is just one factor. But I wanted to, for the sake of illustration, just kind of show you how this works. So, we talked about what this is going to look like 29, 27, 33. This is not your full PITIA. For the person that asked that question, this is just your principal and interest, right? Your taxes and insurance are not going to change. It's pretty easy to figure out what those numbers are going to be. So this is just the P and the I in PITIA. So let's just say we change this to 6.75% interest. You can see that that would drop our total monthly principal and interest payment to $28.53. Guys, that's a difference of $73.50 a month. So it sounds like a big deal going from 6.75 to 7% interest, but really incrementally, it's not a massive change. And you, I hope, have more cushion in your numbers than worrying over a $73 change in your principal and interest payment every month. Sure, over the life of the loan, it certainly adds up, and we all know that you pay more in interest at the beginning of your loan and less pay down of the principal. But the average amount of time that a homeowner keeps their loan is 7 years. And so you really don't end up paying the full interest rate for the full life of the loan in most cases. I'd like to say I knew what that average was for investors. I don't. I think it's safe to say that it's even less than 7 years. I have a lot of people who are wanting to do refis, even if they bought a few years ago, because your property can sort of become like your bank in a lot of ways, right? So you have 20% equity because you put 20% down in your property. Meanwhile, it's continued to appreciate and your principal has continued to come down. So that equity is growing, growing, growing. Well, that's great, but it's just sitting there. And a lot of people sometimes want to tap that equity and pull it out of an existing property by doing a DSCR cash out refinance loan so that you can use that equity to fund your next purchase. So that happens all the time. And I anecdotally, I can't really tell you what the frequency of that is, but anytime you see major movements in interest rate, or you get beyond like the 3 to 4 year mark, you see investors wanting to refi their properties so that they can have access to that equity. Very common. I'm gonna
Awesome.
stop sharing my screen. If that's okay.
Yeah, sure. We don't have any more questions yet, but if anyone has one, go ahead and drop it in. But it's been great having you on, Bonnie, and we're super excited just for the level of thoroughness and diligence that you have. Working with all of our clients. If y'all couldn't tell from Bonnie's presentation, she has got it on lock, and it's just the person that you want in your corner.
Right on.
Anything
Uh,
else to wrap us up, Bonnie? Oh,
we did
also,
have
we do have a
a
question.
question.
Yeah.
Yeah, we have. Oh, hey, Joe. Joe Curtin's on here, one of my favorite realtors in South Carolina area, and one of my fellow property owners in Lake Laura, North Carolina. It's nice to see you, Joseph. Um, it sounds like you were asking. Oh, you're the one that was asking about the air DNA with the trailing data. Yeah, let's talk about that. And then Tarrant had a question about the ground up construction, which actually got answered here in the chat by Matt Miller, by my CEO here at MGM. So Matt, I'm glad to see you on the call as well. I don't know if you wanted to maybe talk about that a little bit so that everybody can be the beneficiary of that response about ground up construction.
I do not think Matt's going to be able to chat if he's not a
Okay.
panelist, but yeah.
I do see a question here from Sandra Hugendorn. What are the current rates for STRs? So again, the rate is not really about whether or not it's a short-term rental. It's the type of loan. The rent is relevant to the type of loan. So if we were talking a DSCR, they're kind of in the 6.5 to 7.5 range for well-qualified buyers. I want to just say this. There's a lot of gimmicky stuff, particularly on the internet. Shocking, I know, where you're seeing like 5.5, 5.85% for DSCR loans. Um, Sure, we could get you to that rate as well, but it almost always comes with a significant interest rate buy down, and it rarely pencils to do that. But if you're interested in that, we can always run those numbers and tell you where that makes sense. But you can safely figure you're going to be in like the 6.5 to 7.5% range, and it really comes down on the DSCR to your FICO and to that DSCR score. What I find is kind of like a golden number where we really start to see things improve is if your credit score is 740 or above, and if your DSCR is 1.2 or above. The higher those two things get, the better rate in terms you're going to qualify for. You're welcome, Sandra. Hey, do y'all lend at 85% on a DSCR? We do have some of those, Joseph. Yeah, we should talk. All right. Cool. Well, it was so nice being able to talk directly with your investors. I can't emphasize enough, guys. Reach out to your lender early and often. Let us be a part of your team. Let's make this happen for you. We're never bothered by your messages. We love doing this. We have a really strong team, and we are definitely here to support you.
Awesome. Thanks so much for being on, Bonnie. And again, if anyone wants to reach out, Bonnie's email is bonnie at mgmcapinvest.com. You can also reach out to me and my team with the client success department at Savvy. You can reach me at scott@savvy.realty. We can help you get connected with Bonnie, help you get connected with a realtor in a market that you're looking at, and hopefully get you closed on a property this year, take advantage of cost segregation, and hopefully keep some of your taxes down and yeah, and get you connected with fantastic vendors just like Bonnie. So on Bonnie, and we're looking forward to having closing more loans with you.
All right, let's do it. Thank you.
All right. Thanks everyone. Have a great day.